Hi, good morning, Andrew. Good morning, everyone. It's a pleasure to be with you. Unfortunately, we have a few technical issues, which means you can't see my video, which may actually be a benefit for you this morning, but hopefully you can hear me nice and clear. So, given around about 15 minutes, as Andrew said, so I thought I'd discuss the outlook of the global economy and focus on three major areas. Number one, of course, the impact of the coronavirus on the global economy, the policy response that we've been seeing. Then we'll go on to look at the UK economy. Where are we? What can we expect from the banking and of course, touch on Brexit, which has been, of course, pushed to the background a little bit as a result of the coronavirus, but those negotiations continue. And finally, we'll consider what the post-COVID-19 world looks like. Starting with the global economy, where the lockdown, as we know, has thrown the global economy into recession. The pandemic has resulted in millions of infections, hundreds of thousands of deaths around the world. The scale of the outbreak has placed enormous pressures we've been seeing on national health services. Governments have been forced to impose aggressive measures, including social distancing, self-isolation and restriction on travel, all in an effort to contain the spread of the disease. Locking down economies has resulted in an unprecedented drop in economic activity, surging unemployment, permanent losses in output, and temporarily slower potential growth. As a result of the disruption, we now expect the global economy to contract by somewhere around 3.7% during the course of this year. Now, to put that in some sort of context, the scale of the change that we've been seeing as a result of the disease at the start of the year, we are forecasting growth of around 3.3% for this year. The scale of the risk to the global economy has, as we know, encouraged central banks to slash interest rates, to inject huge amounts of liquidity into the financial system. Governments have embarked upon an extraordinary fiscal response, including allowing companies to furlough staff, as well as pledging vast sums in loans, grants and credit guarantees. We have to say the reality is future growth prospects will inevitably be determined by the lifespan, the intensity and the geographical spread of the virus. However, the controlled lifting of restrictions should help to alleviate some of the economic pressure, although activity we're seeing playing out in the United States, but in Melbourne and other cities, will continue to be vulnerable to the development of a second wave. And a true normalization of activity will only occur when a vaccine has been developed. I think given the time required to develop, test and distribute a vaccine, it's unlikely to be widely available in the next 12 to 18 months. But with a tentative reopening of economies, the vast level of stimulus instigated by policymakers, we are projecting a recovery into the second half this year and into 2021. We've got global growth forecasted to be 5.2% as you look through next year. However, certain sectors, pretty much the obvious ones, but airlines, hospitality, non-food retail may take many years to recover. We also think there's going to be permanent changes to working patterns, supply chains and global trade as a result. Moving on to the UK economy, no surprise, the pandemic, of course, has disrupted the UK economy, country facing the highest number of deaths in Europe, although you can, of course, debate how these numbers are calculated. But putting that to one side, it's certainly been a difficult time for the UK economy. First quarter GDP fell by 2.2%. Remember, that only contains a few days of lockdown. The second quarter, when we get the official numbers through, is likely to be much, much worse. April retail sales volumes, for example, month-on-month basis fell 18.1%, the worst that we've seen on record. So in terms of our forecast for the second quarter, we're looking at a contraction somewhere around 17%. Again, to put that in some sort of context for you, that's the worst that we've seen in 3 centuries. Quite incredible, although we should remind ourselves it's an awful lot better than was feared just a couple of months ago. The UK data has actually been showing signs of improving over the course of the past few weeks. Activity is rebounding as the economy reopens. If you look at mobility indicators, they've shown a pickup in public transport indicators and driving activity. Electrical power load usage has rapidly recovered from the April lows. There's also signs that households are willing to normalise their spending patterns fairly quickly. So footfall levels in stores have been rising. Sales volumes in May rebounded. That jumped a record 12%, although it's still down around about 13% compared to where they were a year ago. Looking at UK inflation, well, UK inflation fell to a 4-year low in May. Consumer prices rose just 0.5% from a year earlier last month. That's amid weaker demand, falling fuel prices, weakness in transport, recreation and culture goods. We've only seen a modest upward pressure coming from food and non-alcoholic beverage prices. In terms of the outlook for inflation, CPI inflation is expected to fall slightly further in the near term. The drag from COVID-related shocks continue to build. It's then expected to rise, I think, during the course of 2021. The direct impact of the recent fall in the oil price drops out of the annual comparison, and the downward pressure from domestic factors wanes as demand starts to recover. So to give you the headline numbers, as we look through this year into 2021, look for a full year contraction of 7.5% this year. 2021, as we said, should be supported by significant fiscal stimulus and monetary easing. We look for growth of 5.8% for the UK economy. Looking at the Bank of England, seen an aggressive response from the central bank. Bank of England cut rates to a record low of 0.1%, as we know. They've increased the size of their bond buying programme by £100 billion. That total now stands at an astounding £745 billion. But they did slow the pace of purchases sharply, saying high-frequency data pointing to a faster recovery, and also reacting to the stabilisation of financial markets as well. They said they plan to stretch the programme out until the end of the year, which you have to say is still an aggressive timetable by any standard. What are they hoping to achieve through quantitative easing? Well, boost economic activity and reflate the economy. Large-scale purchases of government bonds lower the interest rates or yields on those bonds, thus pushing down the interest rates offered on loans, that's business loans as well as mortgages. Cheaper borrowing should therefore encourage spending. To also remember, quantitative easing boosts asset prices. It drives the wealth effect, and that can lead to an increase in spending as well. There are some unintended consequences of quantitative easing. Puts pressure on investment strategies that rely on long-term interest rates for return, particularly pension funds, encourage investors to take on more risk to get a return. Inflating asset prices also generates further income inequality. No doubt the Bank of England will be watching for signs of that. In terms of negative interest rates, there are lots of headlines around this from the Bank of England. The governor at the most recent meeting said taking borrowing costs below zero was complex and not in any way imminent. Negative interest rates, mind is where the central bank charges retail banks on its deposits of excess reserves with the central bank instead of normally paying an interest rate. The theory being it makes it expensive for banks to sit on those reserves, forcing them to lend the money, thereby stimulating growth and reflating the economy. Does it work? Well, you could argue even the threat of negative rates pushes down borrowing costs lower. Britain sold a bond recently with a yield below 0% for the first time. So, in fact, simply threatening it can be as productive as actually implementing it. Implementing it creates, again, some unintended consequences, cause havoc, as we know, in the banking system, leads to declines in net interest margins. Europe is a very good example of that. Discourages companies from holding adequate buffers against financial stress. Encourages individuals and businesses to take on more debt, which may not be sustainable in the long term, can create asset bubbles, but also creates zombie companies that are detrimental to the long-term development of economies. For us, I think we would need to see a massive deterioration in UK growth prospects for the Bank of England to consider such a move. I think policymakers are likely to remain focused on this coordinated monetary and fiscal approach that we've been seeing. Measures that enhance liquidity, address dysfunctional markets, boost confidence, and stimulate demand. It's pretty much where we see the focus for the Bank of England. Quickly touching on Brexit, Boris Johnson's Conservatives came into power in December, of course, pledging to get Brexit done. Britain officially left the European Union on the 31st of January, formally entering this period of transition. However, the fourth and final round of official talks on the future trading relationship between the UK and the European concluded recently with very little progress, although there have been pledges to pick up the intensity of negotiations to try and get a deal done. Key sticking points continue to be the level playing field commitment. The UK continues to reject EU demands for a level playing field, which would see the UK aligned with the European standards in areas such as the environment and workers' rights. There's also disagreement over the governance and the form of the agreement, along with the sovereignty over UK fishing waters, financial services equivalents, the role of the European Convention on Human Rights, and of course the Northern Ireland Protocol, which is a complicated arrangement which aims to avoid a hard border on the island of Ireland. So where are we today? Well, recent briefings have suggested a compromise could still be reached, whereby Britain deviates from the level playing field. Europe at that point could impose additional tariffs. Thus would allow both sides to claim a victory. But I think realistically, we can expect little progress in the negotiations until near the end of October, with each side holding off as long as possible before moving on those positions. The Bank of England has warned banks to prepare for a no-deal Brexit. The impact of a no-deal Brexit on businesses would be significant, of course. You're talking about trade barriers, talent pool restrictions, regulatory restrictions, changes in taxation. So for businesses, what does a no-deal Brexit mean? Increased cost, increased complexity. That's fundamental changes to their business model. Although you could argue fears of a no-deal Brexit may prove to be less dramatic than the lead up to previous deadlines. Remember, companies have now had 4 years to prepare. Policymakers have promised unlimited support. And you could argue that businesses would finally welcome some much needed clarity. And there are some signs that trade agreements with other countries have been gaining some early momentum, although we should continue to remember that Europe is and will continue to be the UK's most important trading partner. Let me very quickly finish off with how we see the post-COVID world. Past the worst, should I say, does not mean out of the woods, nor back to normal. COVID-19 crisis, we think, will have implications for society, economy and financial markets over the long run. More debt, fiscal deficits and public debts have been skyrocketing, as has corporate leverage. More inflation, less globalization. Then COVID-19 accelerates deglobalization. It started with the trade war, to prompt governments to promote self-sufficiency in strategic areas, particularly like food, healthcare and defense. Technology, of course, has been an important component of all our lives, more important than ever before over the course of the past few months. It's played a big part in keeping the economy afloat when the world went into lockdown. So more working from home, more virtual meetings like we're doing today, less business travel, less office space needed. The crisis, we think, accelerates the digitalization of the economy. More healthcare, I think, is going to be important as well. Crisis reinforces the trend towards more healthcare spending by governments and more universal coverage. I think that's both in the developed and emerging economies. Research budgets could be boosted, as well as spending on infrastructure and equipment. A different type of consumer as well, as we've been talking about. Real shift in terms of spending patterns and consumer behaviour as social distancing rules, working from home and digitalisation forms a change in consumer demand, and retailers will have to adapt to that. So there's some of the major changes that we've been talking about as a result of COVID-19. We don't think we'll go back to the normal world as we knew it before the pandemic. We think the global economy does recover. We know that authorities have been very aggressive in terms of that stimulus. We think that will inevitably shine through, but we need to watch the path of the pandemic very carefully indeed, because that will determine where we go before a vaccine is fully developed and distributed. So that's our view in terms of the global economy, in particular look at the UK. Let me now hand back to Andrew to move on to the other panelists.